Welcome to Spidell's California Minute. I'm your host, Catherine Sedan, and this week we're covering an FTB legal ruling regarding non-resident sales of partnership interest. But first, if you've been waiting to sign up for a year-end tax update, get registered now for Spidell's Federal and California Tax Update webinar or seminar, and we'll send you a client letter covering pass-through entity elective tax refunds that are being erroneously sent back to taxpayers. Go to caltax.com for more details and to get registered. In what will be a surprise for many tax professionals, a legal ruling issued by the FTB says that non-residents who sell their interest in a partnership may very well be subject to California tax on deemed income from the sale. It's always been the general understanding that the sale of a partnership interest is treated as a sale of an intangible that's sourced to the resident state of the partner selling the interest, unless the intangible property has a business situs in California. For example, if it's used as collateral to obtain a loan for the business. In that case, the income is California source income. But according to the FTB, the operation of Internal Revenue Code Section 751 requires that the sale of the partnership interest be treated as two distinct transactions, one in which the intangible partnership interest is sold by the partner and the gain is sourced to the partner's state of residence, and one transaction in which the underlying Section 751 property is treated as sold by the partnership immediately before the partner disposes of its interest, leading to a deemed distribution to the partner. IRC Section 751 property is comprised of unrealized receivables, including depreciation or recapture, and inventories. If the partnership operates wholly within California, all the income from the sale of the Section 751 items is considered California source income. If the partnership operates both inside and outside of California, the non-resident's income from the sale of the unrealized receivables and inventory is treated as apportionable business income. The income from the sale of the unrealized receivables and inventory is required to be apportioned using the sourcing rule appropriate to the items sold. Unfortunately, many tax professionals and their clients have automatically treated the sale of a partnership interest as a sale of an intangible sourced to the non-resident state of residence. This means that they either did not file a California return or they did not include the income from the sale of the partnership interest on their non-resident California return that they filed to report the taxpayer's other sources of California income. If the taxpayer never filed a California return, the statute of limitations remains open indefinitely, meaning the FTB can come back years from now and issue a deficiency assessment against the taxpayer. If the taxpayer filed a return but understated their gross income by more than 25%, the statute of limitations is extended to 6 years. The taxpayer could also be subject to interest and penalties. Taxpayers should consider these potential consequences when evaluating whether to file a California non-resident return to report sales of their partnership interests for the current year or prior tax years. We'll be covering this ruling in more detail in the upcoming issue of Spidell's California Tax Letter. For subscription information and to download a sample issue, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.